China has just delivered a shock Washington didn't anticipate. Beijing has instructed Chinese companies to stop purchasing American-made chips. Almost overnight, the flow of United States semiconductors into China's massive tech sector has been cut off, and the first tremors are already spreading. Scott Bessent, Wall Street's so-called star investor and now United States Treasury Secretary, is reportedly in panic mode. Donald Trump believed he had set a clever trap. He loosened restrictions so Nvidia could sell its new H20 AI chips to China, confident Beijing would rush to buy. From Washington's perspective, it looked perfect. China gets advanced processors, American companies profit, and the United States Treasury skims 15% off every sale. For Trump, it was meant to be easy money, technology, revenue, and leverage wrapped into one. But Beijing didn't just decline, it slammed the door shut and locked it. Xi Jinping's government told Chinese firms to cancel orders not only from Nvidia, but from AMD as well, cutting off two of America's largest chipmakers in a single stroke. Then new rules followed, banning United States chips from government-backed projects entirely. The message was unmistakable. China is finished playing by Washington's rules. This isn't about whether the H20 is powerful enough or whether American processors still hold an edge. It's about control. Beijing wants the world to see it won't be boxed in by United States technology or trapped in long-term dependence. What Washington framed as a win has been flipped into a public setback, and the fallout stretches far beyond one bad deal. United States chipmakers have relied on China for decades, earning billions from its enormous market. Without Chinese buyers, future revenue and global dominance are suddenly in question. The timing couldn't be worse. America is already weighed down by debt, inflation, and political uncertainty. Losing its largest tech customer now is like yanking the rug out from under an already unstable economy. This isn't just trade, it's a battle for global influence. At this moment, Beijing appears calm and calculated, while Washington stumbles through self-inflicted missteps. Now let's slow this down, because what's happening didn't emerge overnight. It's really the result of years of U.S. policy choices that ultimately produced the very outcome Washington was trying to avoid. For more than a decade, the strategy was consistent: keep China away from the cutting edge of semiconductors. Administrations from both parties followed the same playbook: tighten export controls, block access to advanced processors, and restrict sales of critical design tools and manufacturing equipment. The logic was straightforward. If China couldn't access top-tier chips, its progress in artificial intelligence, supercomputing, and advanced manufacturing would stall. On paper, it made sense. But while Washington was drafting restrictions, Beijing was building. China invested tens of billions into its domestic semiconductor industry. Entire industrial zones were dedicated to chip fabrication. Universities expanded engineering programs, training thousands of specialists, while local governments subsidized everything from chip design to lithography research. Progress wasn't perfect, but it was steady, and in some cases, much faster than U.S. policymakers expected. A gap analyst once said would take a decade to close was narrowed in 4 or 5 years. That should have been a warning sign. Instead, Washington assumed China would stay dependent far longer. Then came Trump's trade war, and the pace accelerated even more. Tariffs, sanctions on tech firms, and additional chip restrictions followed one after another. The goal was to weaken Beijing's leverage. The result was the opposite. China treated the pressure as a national mission to break free from American suppliers. Being cut off became fuel. Supply chains were reworked, investment surged, and what had once been a long-term goal became an urgent priority. Eventually, Washington realized U.S. companies were bleeding. Nvidia, Qualcomm, Intel, all had deep exposure to China. Without that market, billions in revenue vanished. So Trump adjusted course. Nvidia's H20 chip, tailored to meet export compliance rules, was put back on the table. To sell it politically, a 15% tax was added to every sale, pitched as a win for the U.S. economy. In theory, China got limited hardware, American firms regained customers, and the Treasury collected billions. But Beijing didn't bite. Instead, guidance went out instructing Chinese companies to cancel U.S. chip orders, including the H20. The timing was intentional. By then, China had unveiled its own high-performance AI platforms, like DeepSeek, proving domestic technology could compete with Western systems. That debut rattled the industry because it confirmed what Washington hoped wasn't true. China no longer needed U.S. hardware to move forward, and the H20 itself wasn't even a full product. It was a deliberately downgraded chip, stripped back to satisfy export rules. From Beijing's perspective, this wasn't cooperation. It was humiliation. Pay more for weaker hardware and allow Washington to skim profits on top. That didn't look like partnership. It looked like dependence with a toll attached. So Beijing made its choice. It cut off U.S. chip imports and turned the move into a display of confidence. The message to Washington was clear. Chinese companies will no longer build their future on American processors. And the message to the rest of the world was just as strong. China is ready to stand on its own. This moment isn't about rejecting a single chip or company. It shows how far the balance has shifted. For the U.S., the ban signals that the strategy of restriction has reached its limits. For China, it's proof that years of investment and preparation are starting to pay off. When we talk about America's reliance on China in tech, we're not talking about a side market. We're talking about one of the largest consumer bases and industrial ecosystems on the planet, so large that losing it can shake entire balance sheets. So, take Apple, for example. China has long been both a key market and a core production hub. In 2023, nearly 19% of Apple's global revenue came from Greater China, almost $1 in 5. And that figure includes not just sales, but also the factories, suppliers, and logistics that keep global launches running on time. If Beijing tightens restrictions, Apple takes a double hit: weaker sales and disrupted production. And honestly, the scale is obvious. Outside the United States, China hosts more Apple stores than any other country. Now, let's look at Nvidia, the face of America's AI surge. In 2022, roughly a quarter of its data center revenue came from China. Chinese AI labs and cloud providers were ordering thousands of GPUs, making China one of Nvidia's most critical markets. But because of U.S. export rules, Nvidia had to design cut-down, China-only chips like the A800 and H20. Without full access to the market, Nvidia risks losing billions. Analysts estimate that unrestricted sales to China could have added roughly $15 billion in revenue, money that is now off the table. Then there's Qualcomm. Its chips power Chinese smartphone brands like Xiaomi, Oppo, and Vivo. In 2023, China accounted for 64% of Qualcomm's total revenue. And those processors don't just stay in China, they ship worldwide. Without that scale, Qualcomm would struggle to fund the research and development needed to stay competitive. Even companies less dependent on hardware sales feel the weight of the Chinese market. Microsoft earns steady income in China through Windows licenses, enterprise software, and Azure cloud services, often delivered through joint ventures and local partners. And Tesla, while not a pure tech company, depends on China as both a manufacturing base and one of its largest EV markets. Its Shanghai Gigafactory alone produces hundreds of thousands of vehicles each year, many of which are sold domestically. So, what ties all these firms together is scale. China isn't just another big market. It's a unique one. Hundreds of millions of middle-class consumers, massive state-backed infrastructure projects, and corporate buyers capable of placing orders few countries can match. That scale doesn't just raise revenue. It creates the economies that make cutting-edge products affordable and commercially viable. And this is where politics collides with reality. In Washington, talk of decoupling has become popular rhetoric. But the numbers tell a different story. For America's largest tech companies, China isn't optional, it's essential. If Beijing ever shuts the door completely, the shock would ripple from corporate earnings to Wall Street indexes within hours. Now let's bring Scott Bessent into the picture. For those unfamiliar, Bessent isn't just another Wall Street figure. He's a hedge fund billionaire who built his reputation betting on global markets before becoming one of Trump's key economic voices. Today, as Treasury Secretary, he sits at the center of U.S. financial strategy. And this chip standoff has pulled him straight into the storm. What stands out is that Bessent may not fully support Washington's hard-line approach. Reports suggest he understands how damaging China's chip ban could be for U.S. firms. Nvidia, Qualcomm, and Intel are already losing orders, and with each cancellation, billions in potential revenue disappear. For someone tasked with stabilizing U.S. finances, that's a crisis too large to ignore. Insiders say Bessent has quietly explored ways to soften the blow, possibly even reopening dialogue with Beijing. But here's the problem. Once China makes a move like this, it can't be reversed with a phone call. Trust has already been broken. Even if a temporary deal emerges, Chinese firms will hesitate before tying their future to American suppliers. That's the real risk. This isn't about a single contract. It's about a long-term shift in global tech trade. And you know, the ripple effects go far beyond chipmakers. Semiconductors power everything. Smartphones, electric vehicles, cloud computing, medical technology, even weapons systems. If China designs products that run entirely on domestic or non-US chips, the broader ecosystem, software, upgrades, intellectual property, could begin to bypass America altogether. That's not just lost revenue, it's lost influence, the core of US tech dominance. The world is watching. If Beijing proves it can replace US chips without sacrificing performance or innovation, others will diversify as well. Each step away from American suppliers gives Chinese firms more room to grow. And with every market that shifts, Washington's grip on technological leadership loosens further. For decades, America's edge in semiconductors has been the backbone of its global power. With one decisive move, Beijing is now testing how fragile that dominance truly is. Across the United States, manufacturers are waking up to a harsh reality. The parts and materials they rely on, specialized machinery, precision components, even raw inputs, are becoming more expensive, harder to source, or failing to arrive at all. What was once a steady overseas supply has turned into delays, rising shipping costs, and endless paperwork on factory floors. The impact is immediate. Orders that once filled entire shifts are drying up. Managers are cutting hours, scaling back operations, and shutting down lines just to survive. Workers promised stability under slogans about bringing jobs home now face smaller paychecks and empty halls. What was sold as a manufacturing revival increasingly looks like survival mode. And this isn't only about China. The trade conflict has widened, straining ties with U.S. allies as well. Europe, Asia, and beyond are rethinking their relationships with Washington. Constant tariff threats and unpredictable policies have left them asking a hard question. Can America still be trusted as a stable partner? More often, the answer is no. That's why countries are quietly building alternatives outside U.S. control. Regional trade blocs, parallel financial systems, and partnerships designed to bypass Washington entirely. Once these structures are in place, the U.S. won't be able to dictate terms the way it once did. That's the bigger picture. While U.S. leaders chase short-term leverage, the global trade system is being rebuilt without them. The real danger isn't just higher costs today. It's the moment the world realizes it no longer needs America to keep things running. When that happens, U.S. leverage won't just weaken, it could collapse. So the question is simple. Has Washington already lost its ability to shape the global economy, or is there still a path back? If you want to keep tracking these shifts and see where they lead, make sure to subscribe and turn on notifications.